Hi, this is Karen Lin. In this video, I want to introduce the idea of NCI, non-controlling interest, to you. In the first three chapters, we talk about equity method of investment. We talk about equity investment and how the parent company can consolidate with the subsidiary. In this chapter, chapter 4, we will introduce a second party in this equation, which is the non-controlling interest. In this chapter, the parent no longer acquires 100% of the subsidiary, but only acquires a portion that enables control. So let's take a look at a very simple example. In this example, the parent, before acquisition, the parent company had $1,000 of assets, 400 liabilities, and 600 stockholders' equity. The subsidiary, for simplicity, is half the size of the parent, so everything is in half. This is before acquisition. Let's assume parent company acquires 70% of the subsidiary without paying any premium, which means it doesn't have any fair value excess of any assets and liabilities. It also pays only what the book value is worth. So 70%, when we acquire the subsidiary, we are acquiring the net asset of the subsidiary, which means we take over the asset, we assume their liability as well. So what the parent bought is basically the net asset, stockholders' equity, or the stockholders' equity of the subsidiary. So 70% of 300, that's 210. So the parent company debit investment 210, credit cash. Let's say it's a cash investment. So cash 210. So assets other than investment becomes 790. It is 1,000 minus 210. Investment 210, right? 70% of the 300. So it adds an asset in the left-hand side of the equation. It subtracts an asset from the left-hand side of the equation. So your total asset didn't change. It's still 1,000. The parent's total asset is still $1,000. Liability and stockholders' equity didn't change. So the parent's total liability plus stockholders' equity is still 1,000. It wouldn't affect the subsidiary. It's only the parent's purchase for the subsidiary. So it would not affect the subsidiary's account in any ways. So now let's take a look at consolidated financial statement. Let's say now we have to consolidate the parent and the subsidiary for reporting purposes. Here I will skip the technical details and talk about the intuition and show you how and why NCI is important. So let's first take a look at the consolidated assets except for investment. Remember, first of all, because of control, the parent purchased 70% of the subsidiary, which means the parent is in control of the subsidiary. That means the parent, through voting, could move the subsidiary's assets and liabilities as the parent's wish. So when the parent consolidate with the subsidiary, the parent would consolidate with 100% of the subsidiary, not the 70%. Okay. Again, I want to say it again. For example, if the subsidiary's 500 assets are all cash, okay, through voting, let's assume parents' other assets are all cash. So through voting, the parent could use dispense subsidiaries cash at its wish because it votes on all the decisions that the subsidiary made. It has the majority voting stocks. So when investors ask the parent company, how much cash do you hold? The parent should say, I'm holding 790 plus the 500 that I'm controlling, not 790 plus the 70% of the 500. That's incorrect because you can vote and move all the subsidiaries cash. So consolidated other assets should be the parent's number plus the subsidiary's number without the percentage of ownership involved. Okay. Now, investment. We talk about in the first two chapters, chapter 2 and 3, about consolidation, that consolidated investment should go to zero. This is because when the parent invested in the subsidiary, it is invested in the subsidiary's net asset, which means the asset minus liability. So when the parent consolidate all the subsidiary asset and liability to its own account, investment account would be canceled out with the owner stockholders' equity because it's a double counting. So investment account should go to 0. Now total asset is calculated from the above. So it is these two added up. That's 1290. Look at liabilities. Liabilities, the same idea. It is the parent's number plus the subsidiary's number at 100%. Okay. Stockholders' equity. Stockholders' equity should only be the parents, right? Remember, we talked about that in the first 2 chapters. It is because the parents' owners are the only owners of this whole entity. The entity consists of parent and a subsidiary. So consolidated stockholders' equity should only be the parents. Now let's add them up. Okay. We can see now it's interesting because our total asset does not equal to liability plus stockholders' equity after consolidation. This means there is a problem there. Okay, where is the problem? The problem is we ignored the fact that although we add 100% of the assets and liabilities to the parent's own assets and liabilities, the parent doesn't own 100% of the subsidiary's asset minus liability. It controls 100% of it. That's why we are adding all of them to the parent's numbers. But the parent does not own 100%. So control and ownership are two different concepts. Control means control through voting, but own means paying cash or paying consideration transfer to obtain the voting stock. So the parent only paid 70% for the subsidiary, which means there's another 30% outside. It's the outside investor, or we call non-controlling investor. So there must be an NCI which should not be appear on the parent. Obviously, it's not part of the parent, it's not a part of the subsidiary. So NCI does not appear on either parent or the subsidiary's account, but it is on the reported consolidated financial statement. Now you can guess what that is, right? That is the 30% asset of the subsidiary. So it should be 30% of the 300 net asset of the subsidiary. So that's fine. If I'm adding this whole thing up, oops, sorry. If I'm adding these three things up, it is 1290, the same as total assets. So now let's summarize. The idea of NCI is when the parent controls 100% of the subsidiary's assets and liabilities through only a portion of the ownership, then when the parent consolidated with the subsidiary, this consolidated financial statement would reflect this fact that the parent only owns a portion of the subsidiary and another small portion is owned by a party called non-controlling interest. Okay, in the meanwhile, the parent would be called the CI, which is the controlling interest. Okay, so that is what I'm trying to do in this video. In my next video, I'll show you how we consolidate with the NCI column.